Moody's artificial intelligence recession model is currently sitting at 49% probability. That means one of the most sophisticated economic forecasting systems in the world is saying there is almost a coin flip chance the United States enters a recession within the next 12 months. Goldman Sachs puts that number at 30%. JP Morgan recently revised their estimate to 40%. And this is before factoring in the Iran war's impact on oil prices, which historically have preceded every major US recession of the modern era. The S&P 500 is down roughly 7% year to date. The Dow entered correction territory. More than 40% of Americans believe an economic collapse is coming in the next decade. And in this environment, most people do one of two things. They panic and sell everything. Or they freeze completely and do nothing, which is actually the more dangerous of the two. This video tells you exactly what happens to your money during a recession, what history says about recovery, and the 3 specific moves that protect and position your finances regardless of what the economy does next. We are going to cover what a recession actually does to your investments using real historical data, why the 2 most common responses to economic downturns both destroy wealth, which specific asset types hold up best, and a clear 3-step action plan you can start today. No predictions, no panic, just the data and what it means for you. This is Wealth Clarity. Let's get into it. Let's start with the mechanics, because most people's mental model of what a recession does to investments is shaped more by news headlines than by data. A recession is formally defined as 2 consecutive quarters of negative economic growth, meaning the economy contracts for at least 6 months. The United States has experienced 12 recessions since World War II. The average recession lasts approximately 10 months. The longest recent recession, the 2008 financial crisis, lasted 18 months. Here is what happens to the stock market during those recessions based on historical data. Mild recessions, like the 2001 dot-com crash, typically produce S&P 500 drawdowns of 25 to 35%, with recoveries taking 2 to 3 years. Moderate recessions, like the 1990 downturn, produce drawdowns of 20 to 30% with recoveries in around 12 to 18 months. Severe recessions, like 2008, produce drawdowns of 40 to 55%, but are followed by the strongest and longest bull markets in market history. There are 2 critically important things buried in those numbers. The first is that every single recession in US history has been followed by a full recovery and new market highs. Every one. Not most of them. All of them. The stock market has finished the year in positive territory more than 75% of the time over the past 4 decades, including years that contained recessions. The second is that the recovery begins before the recession ends. Stocks tend to begin rebounding during recessions, in anticipation of economic recovery, not after. This means by the time the recession is officially declared over, which happens months after the economy actually turns, investors who sold have already missed a significant portion of the rebound. This is why the relationship between recessions and your investment returns is not as simple as recession equals losses. Recessions equal temporary losses followed by permanent gains for investors who stay invested. Now let's talk about what most people actually do during recessions, and why both common responses are financially devastating. Mistake 1 is panic selling. When markets drop and recession dominates the news, the emotional pressure to sell is enormous. Your brain's loss aversion response, which we covered in an earlier video, makes the pain of watching your portfolio fall feel physically unbearable. And the natural response is to sell, protect what's left, and wait until things feel safer before buying back in. Here is what that decision actually costs. Charles Schwab analyzed the S&P 500 returns from 2006 to 2025, a period that included the 2008 financial crisis and the 2020 COVID crash. The annualized total return over that period was 11%. But if you had sold during downturns and missed only the 10 best trading days over those 20 years, just 10 days out of approximately 5,000 trading days, your annualized return dropped to 6.6%. 10 days. Over 20 years. The difference between 11% and 6.6% compounded over a full investment lifetime is the difference between building serious wealth and falling behind inflation. The problem with waiting for things to feel safer before buying back in is that things feel safest at market tops and most dangerous at market bottoms. Human emotion is systematically backwards relative to optimal investment timing. Mistake 2 is doing nothing, including nothing new. The investors who build the most wealth during recessions are not the ones who hold their existing positions, though that is important. They are the ones who continue investing regularly through the downturn, buying more shares at lower prices through a strategy called dollar cost averaging. When the S&P 500 drops 20%, every regular investment contribution buys 20% more shares than it did before. When the market recovers, which history says it will, those additional shares purchased at lower prices amplify your returns significantly. Recessions are not just survivable. For long-term investors with a regular contribution strategy, they are genuinely advantageous if you keep investing through them rather than stopping. Not all investments respond identically to economic downturns. Here is what the historical data shows about which asset types are most resilient. Large-cap stocks, companies with market capitalizations above $10 billion, including most S&P 500 firms, tend to have stronger balance sheets, more diversified revenue streams, and greater access to capital than smaller companies. These characteristics make them more resilient during economic contractions. This is one reason why a simple S&P 500 index fund is more recession resilient than many people assume. Investment-grade bonds typically hold their value or increase in value during recessions as investors move money from stocks into perceived safety. A portfolio that includes some bond exposure, particularly for investors within 10 years of retirement, reduces the volatility of downturns significantly. High-yield savings accounts and cash equivalents become more valuable during recessions for two reasons. First, they protect you against an unexpected income loss, which is the primary non-investment risk during an economic downturn. Second, they give you the ability to continue investing and capture lower prices rather than being forced to sell investments to cover living expenses. Defensive sector stocks. Companies selling essential goods and services that people continue to buy regardless of economic conditions historically show less volatility during recessions than growth or technology stocks. Consumer staples, healthcare, and utilities tend to hold their value better when discretionary spending contracts. What holds up the worst? Highly leveraged companies, speculative growth stocks, and individual positions in sectors that contract severely during downturns. This is precisely why broad diversification through a total market index fund provides better recession protection than concentrated positions. You own the resilient parts alongside the vulnerable ones, and the resilient parts offset the damage. Here is the specific three-step plan for your money right now, whether a recession arrives or not. Step 1. Build or confirm your emergency fund before doing anything else. The greatest financial danger of a recession is not portfolio losses. It is being forced to sell investments at depressed prices because you need the cash for living expenses after a job loss or income disruption. 3 to 6 months of expenses in a high-yield savings account, currently paying 3 to 4% annually, is the difference between riding out a recession and being forced to crystallize your losses. If your emergency fund is not at 3 months of expenses yet, redirect additional investment contributions there first until it is. Step 2. Do not change your investment contribution strategy. If you are investing a fixed amount each month into an index fund, keep doing exactly that, regardless of what the news says. Dollar cost averaging through a recession is one of the most reliable wealth-building strategies in investing history. The companies inside your index fund are continuing to operate, continuing to generate revenue, and in many cases continuing to pay dividends. Your ownership of them is not diminished by a lower share price. A lower price means your next contribution buys more. Step 3. Review your asset allocation based on your timeline, not your emotions. If you are more than 15 years from retirement, a recession is a buying opportunity and your allocation should remain growth-oriented. If you are 5 to 15 years from retirement, this is a reasonable time to review whether your stock-to-bond ratio reflects your actual risk tolerance and timeline. If you are within 5 years of retirement, a financial advisor review is worth the cost. The sequence of returns risk in this window is real and worth managing with professional guidance. What you should not do is make dramatic portfolio changes based on recession forecasts. Nobody, not Goldman Sachs, not Moody's, not any AI model, can tell you with certainty that a recession is coming or when it will end. The 49% Moody's reading means there is also a 51% chance of no recession. Positioning your entire financial future around a coin flip is not a strategy. Maintaining a diversified, consistently funded long-term investment posture is. Here is everything we covered today. Recessions are a normal and regular part of the economic cycle. Every recession in U.S. history has been followed by a full market recovery and new highs. The 10 best trading days over a 20-year period, days you miss if you sell and wait on the sidelines, account for much of the S&P 500's long-term returns. The two mistakes that destroy wealth during recessions are panic selling, which locks in temporary losses permanently, and stopping investment contributions, which means missing the opportunity to buy more shares at lower prices. The three-step plan is build your emergency fund first so you never have to sell investments under financial pressure. Keep contributing to your index fund regardless of headlines. Review your asset allocation based on your retirement timeline, not your emotions. The current environment, Moody's at 49%, Goldman at 30%, the S&P down 7% year to date, is exactly the environment where calm, informed investors make decisions that separate them from the crowd. The crowd panics. The informed investor checks their emergency fund, confirms their contribution schedule, and keeps going. You now have the information to be the latter. If this video helped you think more clearly about your money during uncertain times, subscribe to Wealth Clarity. New videos every Wednesday and Saturday. YouTube will show you the perfect next video right on your screen. I will see you there.